Evening, everyone. Thank you so much for taking the time out and joining the first webinar in our series. We are celebrating 7 years of Alpha, and we thought we'll plan a series of webinars to just celebrate this occasion. I'll just quickly tell you, Alpha Alternatives is like you now guessed, a 7-year-old platform, basically focusing on investing. We're building a multi-asset class platform. So we do focus across asset classes: commodities, equities, credit are the 3 asset classes that we are currently active in. And we do have, views around fixed income and currency as we go along. I'll try and take you through the panel today. So who are the people who are speaking with us, who are with us today? Let me just quickly introduce the panel. First and foremost, we have Arvind with us, Arvind Sanger. I think a lot of you have heard Arvind over the years. He's a fairly well-known figure in India. Arvind is currently now based out of the US, but he has also spent a lot of years in Singapore, and I think out of Asia and now out of US. We do keep hearing him and his views. He has been a global investor and he knows the Indian markets very well. So Arvind has been the founder and managing partner of Geosphere Capital Management, which is a global long-term hedge fund focused on natural resources and industrial companies. Before that, Arvind spent many years with SC Capital, where he was a portfolio manager running a fairly large team of people out of New York and Singapore. Arvind has also spent a few years in his career before that on the sell side, typically focused on the oil services and equipment industry, including firms like and DLJ and all. He is of IIT Bombay. I think the one other thing I would like to mention about him, he's been a very active supporter of the cause of education in India. He's been a former chairman of Pratham in the US. He's very closely associated with Pratham over the years. Amit, Bhartia is our other speaker for the day, other panel participant for the day. Again, I think Amit needs no introductions. Most of you have heard Amit over the years, seen Amit over the years. He is actually celebrating his silver jubilee with GMO in this year. He joined GMO in 1995 and he's been a partner with them for quite a few years now. Amit he's the portfolio manager for GMO's emerging markets equity team, also oversees their fundamental research. He also serves as the CEO and executive director of GMO Singapore. So he's been there, investing into the emerging markets and into India for the last 25 years. A very, very good understanding of the Indian markets. He is also a CFA and of course a Bombay grad. So Amit also spent his early years in Bombay, studying engineering in Bombay and also doing his MBA here. We also have Karthik Muthuswamy. Karthik spent about 10 years of his career from 2007 to 2017 with Elliott Associates, which is, I think, the second oldest hedge fund in the world under the same management, done about 40 billion of AUM. And Karthik was the advisor for Southeast Asia. He was investing into India for that period of time. He got a very stellar track record of investing. He was also working with a firm called M3 Investments for 3 years as a fund manager before that. And prior to that, he spent time with GT Investments as a director and analyst for the first 4 years. He is also a BBA gold medalist and a CFA. Karthik loves to trek. He's a mountaineer and he's a trustee of the Mountain Institute of India. And lastly, our moderator for the day, my friend and partner, Prashant Kothari. Prashant and I go back about 27 years now. So Prashant started his career with Peregrine in India on the institutional sales side, spent many years in the US with Deutsche Securities and a few other firms, working on the sell side in the institutional equities market, moved to SSE Capital and was a part of Arvind's team, and then came to Singapore along with him, where he has been for the last 15 plus years. Prashant was also a founding partner with Arvind on Geosphere, where he spent about 5 years helping scale up the platform. And the most interesting thing about Praco that I like, we call him Praco, is that he's a very avid traveler. He has visited more than 57, 58 countries. So he's an SRCC grad and an IMA grad. And you can, besides speaking to him about markets, you can speak to him a lot about which country, what's happening on the ground. So I'll now hand it over to Prashant. He is your moderator for the day, and we all hope that he'll be able to get us very, very interesting insights from our panel, from our panelists, most of whom have, very good ideas to bring to us from the international side, which is something that we'd love to have at this point of time. Prashant.
Thank you, Naresh. I hope you guys can hear me. First of all, I am really excited to have three of my close friends and mentors on this chat, and some people who are really respected as investors. I'm going to start by asking Arvind. We're going to make it very conversational. I'm a moderator, but we're going to make it, anybody can jump in with a question from the panelists. Arvind, you are a global investor and you are an absolute return investor. How do you view India at this point of time as an investment destination?
Well, I will say two things. Thank you for, first of all, having me. And then, as far as India is concerned, right now, this is a money printing world we are in. So COVID is the backdrop. Money printing is the forefront of what central bankers and many governments, especially in developed markets who have the wherewithal to write big checks, are doing. That money is finding its way into investment assets. As an investor, I have to respect that liquidity and try to ride that liquidity wave while realizing the fundamental risks that exist to economies. I think, eventually COVID will pass, whether there'll be herd immunity or there will be vaccine. That'll happen in the next, I think in the next year, we will have either way come to the other side with some short-term damage and some long-lasting damage. So in this investment world, keeping in mind that liquidity, not trying to fight it, I have to find opportunities to invest in companies that can do well, and keep in mind also that when the vaccine or any kind of hope comes, there's going to be massive dislocations in terms of what works right now versus what works later. So India within that context, so having framed that context, if I may, then within that context, India fits in as one of the beneficiaries of global liquidity, one of the beneficiaries of risk on, but an economy that went into COVID with a lot of challenges economically, fiscally, banking system, particularly the shadow banking system, NBFCs as we call them in India. And I think that those challenges will get worse. Therefore, one has to be very careful in picking areas which will do well and which will come out of this. We don't know when the music will stop on the COVID liquidity or when the market will start discounting the music stopping on the COVID liquidity. And therefore, keeping that in mind, can't just ride the things that worked in the last cycle, but have to keep in mind what will be the short, medium, and long-term implications of what is going on right now.
I mean, we are going to discuss that a little bit more in detail on what is working now and what will work in the future. But I want to bring in Amit here. Amit, you've done a white paper on the preparedness of COVID, the impact of COVID, and how different economies in emerging markets have prepared for it and how they're likely to come out of it. Where does India rank in your study?
Thank you, Prashant. So, we recently wrote a white paper on this subject and it was widely appreciated in the media. So what I did was I looked at two pillars to identify economies that can face COVID. So one is COVID vulnerability, how prepared are these economies to COVID, in which I looked at 4 metrics: data reliability of countries, what is the effectiveness of lockdown, how social distancing, is it effective or not, and finally, how prepared is the medical system. So I ranked each emerging market in each of these metrics. Then the next pillar I looked at was, what is the ability to respond, right? So, in which I looked at 5 pillars, what is the state of government finances, what is the monetary response capacity, how vulnerable are these economies, how readiness is the healthcare system, And finally, what is the risk of social unrest? So I ranked about 22 emerging market countries and developed countries on these metrics and looked at a quadrant in which countries that rank badly in these two metrics are very, very vulnerable, in my opinion, and vice versa. So India, obviously, if you look at the COVID score, it's deteriorating quite fast. So when we first published the paper about 3 months back, India was not that risky. And we all know the data with 2 million cases in India and about 25% of global cases, which are now in India. So India is pretty vulnerable on that metric. And second, when I look at ability to respond, obviously India ranks quite poorly with, even before COVID, India's fiscal deficit was quite high. GDP growth was, I think, at a 10-year low or something like that. So I'm afraid, in my opinion, India is pretty much an underperforming country from an emerging context and from a global context.
Okay, that's very interesting, Amit. I want to bring in our third participant, Karthik. You have been doing a lot of trips in India recently. What are you seeing? What is the impact of COVID? I mean, market seems to be quite disconnected in some ways with the economic ground reality. But what is the ground reality? What have you found from your road trips?
Thanks, Prashant. So yeah, I have made now 2 road trips, one in June, one in July, where we just drew down 3-4 days from Bangalore, where I stay, into different. We did 3 states in the first trip, another 3 states in the second trip, and what we find is on the ground, it's very, very painful. There is massive dislocation of labor. There is dislocation in terms of employment. The healthcare system, if you move out of the big cities, which is where we hear a lot of the noise, is totally non-existent. And in July, we compared to the June trip, in July trip, we are seeing early evidence of the virus fairly rapidly spreading into second and third tier cities. So on the ground, situation is worse than what the markets definitely indicate. I think, which we all know. It's also, I think, getting substantially worse than the big cities. So the first 2-3 months of COVID, I think the safest places in India were the smaller towns in rural India. Today, it's, I think, reversing rapidly.
Okay. So that's probably not that good. Now, all three of you have very different styles of managing money. I want to understand from you, how in this market would you be looking at the opportunities? What do you think are the current opportunities in the market, where fundamentally or technically, momentum-wise, you can go and expose your portfolio? What would you be doing in this market? Maybe we start with Arvind.
Okay. Well, I mean, I guess when you say market, let me talk about the Indian market, and then I talk in a broader context. In the Indian market, I own and I've invested in things that I think will benefit from a change in perception of, of people in India. For instance, healthcare, right? Both domestic-facing healthcare and global kind of pharma type of companies. There is dislocation which is going to create, I think, a shift up in spending that is long-term now. We bought it early. The stocks have started to move in a big way, especially the API names. But that's certainly an area, whether it's medical testing or it's anything else, I think that there is going to be a shift in consumption as people become more health, aware, and health insurance, anything like that is going to see, I think, a massive secular move up. Another area that I think is going to be a big benefit to us in our mind is going to be companies, IT services companies, serving the world, because as the CEO of one of the largest IT services companies in India told me the other day, one of his biggest customers in the US said that if my employees are working from home out of Ohio and they told me that this work couldn't be done outsourced, suddenly that argument doesn't work. And why can't I move my work from, Ohio to Bangalore? So I think there is going to be a ramp up over the whatever growth rate we've seen in that outsourcing And I think that is going to be kind of a longer term trend. And I guess for us, other than that, it would be special situations, but clearly balance sheets that are bulletproof. Because although there may be plenty of liquidity in the world, there is no liquidity in India or elsewhere for bad balance sheets, and there is going to be a lot of pain associated with that. So taking balance sheet risk on top of any operating leverage is clearly, it was already out of fashion in India before COVID. It certainly is not coming back because of COVID.
Amit, from a asset allocation point of view.
I think I will. I'm extremely prudent in in our portfolio positioning, very defensive, and one of the reasons I think is it's actually a bear market that's going on because if one looks at equities globally from India or from even a global context relative to a neutral currency like gold, every other equity market is actually underperforming. Point number one.
Right,
And
okay.
second is if you look at an equal weighted index, whether it's in US or whether it's in India, the equal weighted indexes are actually doing quite poorly. It's just a handful of stocks, even if you look at India, whether it's Reliance or even if you look at US, a few names have dominated, indexes. So massive divergence between equal weighted indexes and cap weighted indexes. So I think one should be quite careful in interpreting these market moves, be fairly defensive, be well diversified in their portfolio positioning. That's what I have done.
Excellent. And in terms of your asset allocation, I know GMO is very famous for doing this asset allocation thing. What are your models saying? How much money in equities versus bond versus bullion versus real estate? What are you guys thinking?
So from our asset allocation team, and as you know, Prashant, they are very widely respected and our 7-year forecast have been very widely followed across the world. So we think, emerging markets as an asset class will do much better. And I believe that because recently I even wrote a white paper on this subject in which I argued that structurally, emerging markets are significantly better positioned in the coming decade compared to the last decade. As we are all aware, emerging markets did extremely poorly the previous decade, right? 3 to 4% returns, and India was no exception. And we think the asset class is significantly more resilient going forward. So in some sense, that's positive for India, I would say. So we like emerging markets. We don't like bonds. We don't like US equities. That's pretty much, what our asset allocation team is saying globally.
Okay. And Karthik, as a value investor, are you finding value when markets have collapsed, or are you thinking this is still risky to wade into these markets with no valuation support?
It's been extremely tough to be a value investor globally and in India in these liquidity-driven rallies. So what we have done even pre-COVID is to have a very defensive portfolio, which is we have a lot of special situations in our portfolio, and we have a lot of high dividend yield, zero debt companies. So that's actually served us very well, and but it's been very, very defensive. What we are now finding opportunities is we are finding a lot of companies which are going to be structurally affected by COVID in the long term, and we think a combination of valuation and structural factors make a lot of these companies good shots. So last few weeks and months, we've been more focusing on finding those structural companies where we think over a period of 3 to 4 years, these companies could actually turn out to be much weaker than what they are today. So it's the allocation is largely defensives and special situations, and companies where we think are structurally broke is where we are shorting them.
Okay, great. So 2 of our 3 panelists are clearly bearish on Indian markets. Now, this is where the dichotomy comes for most investors. Markets are going up, and so how can one adjust their portfolio where they can take some advantage of equity moving up also? But market fundamentally, if you look at the valuations and all, we are looking at historically high valuations, maybe because the earnings have declined significantly due to COVID. I don't know if the market is expecting a V-shaped recovery. Is it that kind of optimism which is taking it higher, or is it the fact that probably the cost of capital is now coming down on a long-term basis, and that's why the re-rating is going on? So I just want some views around that. You think, where are the valuations in this, and do valuations really matter now in this liquidity-driven world? Should we really care?
Valuations, I'll go first. Valuations always matter. And if I give the impression that I'm very bullish about India, I'm not bullish about the Indian economy at all. In fact, I think one of the biggest risks that lie ahead is potentially, real weakness in the rupee and depreciation there if the fiscal deficit keeps expanding. See, in the U.S., here's a global point that I didn't make earlier. One of the things that I think is going to happen, probably coming out of COVID, is that all governments are going to build up a huge amount of debt. And it's possible that you will have central banks in the developed economies, whether it's the European Central Bank, the Fed, ECB, the Japanese Central Bank, all practicing what is called financial repression, which is sitting on long-term interest rates to keep them artificially low while allowing governments to inflate their way out of the debt situation, which could have implications for other economies. But countries like India, which don't have that luxury and run up large fiscal deficits, there is a risk that there is a move to try to monetize the debt, and there is talk about RBI doing that. And I'm not sure what the RBI decision making is, because I'm concerned that that's been one pillar in tough times for India. And one of the news that came out last week was extremely worrying to me about indicating the mindset of RBI. I'm a big bull on gold, and I bought a gold loan company in March in India, which has turned out to be great, because that's the one part of the financial system where people can get loans, is gold loans. But last week, RBI announced an astounding decision, which was to allow banks to lend 90% LTV against gold. To me, that was the classic marker of a short-term top in gold prices. Think about it this way, that if I take 100 rupee gold to a bank and I get a 6-month bullet loan, which is not untypical, and I get 90 rupees and the interest rate is 20% a year, I'm paying back 99 rupees in 6 months. So the RBI is asking banks to speculate on the fact that gold prices 6 months from now will be at or above today's levels. Otherwise, every bank is going to lose their shirt on gold loans. That was a classic, top of the market move by RBI. But the fact that they would do things like this shows desperation compounded with, who knows what, which worries me about the future direction of policy in India, which is one of the risks that I see for the Indian economy. As far as valuations are concerned, to answer your main question, I think worldwide, I'm also, growth at a reasonable price kind of an investor. I wouldn't put myself strictly in the value bucket, but it is quite challenging and quite a lot of work to find reasonable evaluations, both in developed market and in emerging markets. I think that's one of the challenges. NASDAQ is hitting all-time highs. Those companies won't stop going down. Reliance goes up every day, but value is not easy to find.
So Amit, the question for you. I mean, and we know we are bearish, but in India the problem is that growth at any price. Most of the quality companies are trading at valuations which are fairly expensive compared to other markets or compared to their own history also. I mean, companies trading at 60, 70 time earnings have become a norm there. How do people expect to make money? Is it like a defensive bet in the sense that index funds are basically buying these companies irrespective of valuations, and mutual funds are sitting on those because they don't want to go on the real economy where the dangers are much more. So these companies are being traded at very high valuations. What is the long-term return forecast for some of those, well-loved companies which are trading at 60, 70 times multiples?
I think there are enough examples in history that if you pay exorbitant valuations for any company, long-term returns are quite poor. I mean, forget these companies. Even if you look at Nifty's returns, last 5 years, 10 years, it's actually been very disappointing. I mean, I think last 10-year returns in real terms is less than 1 or 2% a year. In maybe dollar terms, it's 2 or 3% a year. Less than money market, less than fixed income, and you incur huge amounts of volatility within the asset class. So I think pretty much what we've seen is a lost decade in India. The good part in India is India and US are among the few economies in the world where there is massive sector divergence, right? So there are enough opportunities within the Indian economy, and pretty much any global theme one can play in India. If you want to play gold, as Arvind said, you can play a gold financing company. If you like technology, there are technology companies and so on. So there are definitely opportunities for Indian investors. I mean, if you are smart and diligent, but on a broader level, to answer your question, I mean, it's quite possible returns can be quite poor for the index as well as some of these high-flying companies. I mean, if you look at early 90s, right? I mean, Hindustan Lever, pretty much for 8 years, it did nothing. Infosys, if you bought it at March of 2000, it actually did nothing for a few years. So one should be extremely careful about buying into these high-flying companies.
And Karthik, you've been looking at companies from a bottom-up perspective. Any thoughts around different sectors on where you're seeing that there is a scope for recovery happening and where you think there are structural challenges from your perspective?
So I think, as Amit says, last 10 years has been very disappointing returns for investors in the large caps or the Nifty index investors. It has been a very stock pickers market, and I suspect it will remain so for the next decade, maybe next 5 years, given valuations where they are today. It's exceedingly difficult to make reasonable money in the Nifty stocks today, and you need to go bottom up and find those stocks where you could find significant mispricing. Where we are finding opportunities is we are finding even before COVID, but I think COVID has accelerated the trend of the smaller players in each industry dying out rapidly. This is a global trend. It happens in India, but we are now seeing that in smaller industries. You could see this in auto ancillaries. You could see this in tiles. You could see in many smaller industries where the leader or the top 2-3 companies takes it all. Rest of the guys don't get financing, they don't get equity, and GST and a whole bunch of other factors are pushing this consolidation. So we are finding some pockets there where if you go into mid-tier industries, not companies per se in that, where there is a fight for leadership, and what you're likely to see is top 2-3 companies emerge in each industry, even in these sectors. So that's one area where I think there could be pockets of opportunity. The challenge here is even these companies, there are a lot of significant overvaluation. So it's sometimes walking through a minefield. So, but we are finding some pockets of opportunity there. The other area where we've been finding pockets of opportunity, and we've had a couple of companies in that space this year, is really beaten down companies. Last few years, we've been focusing on some of these beaten down companies where we don't see a balance sheet risk, but we see operational improvements coming in. It's, again, I must caveat, it's picking a needle in a haystack. It's difficult investing, but these are the areas where we are finding pockets of value. the broad overall market being expensive means you need to work harder, dig deeper into these kind of spaces to find value, which has been a fairly big challenge last many years. And I suspect it will continue to be so next few years.
For next few years, huh? Okay.
Because the overall market is expensive, as Arvind and Amit say, you know.
Yeah. But, I mean, the counter argument to this has been that market is expecting a V-shaped recovery. And that is part of the reason why some of the old economy stocks are now starting to run in some ways. The market breadth has been very narrow in India also, like all of the markets. But given the recent rally, do we really think that this is based on a V-shaped recovery? And what are the sort of challenges to getting a V-shaped recovery in the economy side?
I mean, I can start on that. I don't think so there is any V-shaped recovery. I mean, if you look at the recent data, I mean, if you look at recent Google mobility data or Apple data, for example, it's very telling. And my view is that looking at high frequency indicators, I mean, the third quarter will be quite poor. For example, I mean, if you look at pre-COVID, there was about 400,000 daily passengers, airline passengers. Now it is about 60 or 70,000, and it's coming down. So lockdowns continue to happen within India. A lot of states have their own rules, as we are aware. So I think, and if you look at last quarter, India did about minus 20% GDP growth, one of the lowest within emerging markets and pretty much in the world, whereas China was about 3% last quarter. So my view is that it's not a V-shaped recovery. We'll be disappointed.
Arvind, we were discussing about India's preparedness in case we see some bankruptcies in India, whether the Indian system can handle it, and if there are things that the RBI or the government can do to support the economy.
So that's another area where I think, I was on a call with Arvind Subramaniam, the former chief economic advisor, last week, and I asked him about the bankruptcy law, and he was kind of there in the government when it was put in. And one of the things that he said that was put in at that time, which I told him that needs to be revised, and he agreed completely. And then he went into a whole defense of why it was put in, is that promoters cannot buy back assets out of bankruptcy. That is that was a populist but extremely regressive step when it comes to bankruptcies all over the world. This is going to be a classic case where there are going to be thousands and tens of thousands of businesses all over the world going bankrupt, which essentially should be a debt restructuring. And that debt restructuring doesn't mean the assets changing hands, because you want some continuity. And India has unfortunately painted itself in a corner, and recognizing this and political will, unwilling to take on the challenge of suspending that rule. The RBI announced last week in the same meeting where it gave this 90% gold loan move, it announced that it's appointing a committee of 5 eminent people led by KV Kamath, former ICICI Bank CEO. Of course, ICICI Bank did such a good job managing its loan book in terms of not getting bad loans. But he is going to be in charge of a committee that will make decisions on how to handle the restructuring of COVID loans. I think that's a bad move. I think if you have created a bankruptcy system, letting it work, letting it deal with this process is the best way to do it, rather than bringing in a new committee, which will now deal all of this. So my problem is the systemic kind of risks in India of how you will deal with the restructuring, the massive amount of debt restructuring that needs to happen. Right now, we're kicking the can down the road with this moratorium, but eventually this will have to be dealt with. And I don't see a coherent strategy, just like there wasn't a coherent strategy to deal with the NBFC crisis before we went into the COVID crisis. And now we have this new crisis. So, I know Amit said emerging markets, this will be the decade. it will be the decade for emerging markets that can come out of COVID with a robust financial and economic system. Now, I'm riding the wave of liquidity right now in India, but I can't pretend to say that I have high confidence that India will be one of the strong ones standing when we come out of this, which will clearly not be a V shape, but whenever there will be a recovery and economies start limping back out of this, how will they deal with this debt restructuring, and does the financial system and the central bank and the fiscal system have the wherewithal to deal with it? And I just don't think that either the fiscal space or the thinking in terms of how to deal with it, or the institutions to deal with it, are showing signs of of being prepared to deal with it.
Fair enough. Karthik, anything to add?
Yeah, so I am happy that for change I seem to be the most bullish guy on India in a panel. So yeah, so I think I agree with Arvind and Amit that this is not going to be a V-shaped recovery. I think it's going to be gradual and long, but I think eventually we will fix this, and I remain confident. I hope so, that over the next 1-2 years we fix a lot of these issues, and we probably will come back to becoming a growth market. So there's very early signs. The kind of people the government seems to be engaging in, trying to work things around. I think it is going to be gradual and long, but I think we'll fix this.
So some of the questions I'm seeing from our audience, very interested in finding out at this moment, how much are you invested in Indian equities as a percentage, and how much of the total assets should be invested in equities to begin? I mean, as a global investor, you want to take that first? How much of your portfolio will be invested in India right now?
Actually, I would say that my India exposure, without talking about percentages, is I was sitting on a lot of cash in India. I have an India dedicated fund, and I'm now almost fully invested in the last couple of weeks. And it is not because I'm saying that there's great values, but yes, there are special situations where we found value. But I would argue that we are finding that the companies that we have ended up investing in are almost all not India facing. So India consumption basket is almost unrepresented in our portfolio. India infrastructure basket is almost completely unrepresented in our portfolio. It's mostly, either healthcare facing or it's global facing. And there are very few select special situations. But one of the big themes we played, which fortunately the stock has doubled in the last year we played before, is a company that is a huge beneficiary of China outsourcing. Again, I don't think that the government has everything perfectly, but they've done enough and they're offering enough incentives. There will be some winners from the sourcing moving from China to India. And this that we're doing because of trade war has really caught fire now because of all the additional incentives being offered. So there will be special situations. It's not cheap, the company today, but I believe that the company's earnings will double or triple in 5 years. So therefore, there is a huge tailwind. So again, I think that there are special situations where we are finding opportunities in India, but I would say that I remain cautious investor in India because I worry about global macro risks causing, when and if the liquidity does go out, emerging markets, there'll be better buying opportunities than today. But right now the liquidity wave is carrying it. And I think the biggest risk, even though it may be right on the long-term view of emerging markets, right now there's a liquidity wave. And we have to respect that when that liquidity tide recedes, emerging markets are always one of the sources. And again, that may be a wave that turns around very quickly. But it is a risk to keep in mind. So we're staying relatively liquid in terms of names that we can reverse positions in if that liquidity recedes, because that is going to be a challenge.
So Amit, from your perspective, I mean, as an emerging market investor, if it is only a liquidity game, then how are you sort of focused in managing your portfolio for India?
For India, as I said, I mean, the advantage of India is given the breadth of the market, right? You can pretty much play any global theme. So, as Arvind said, he's actually playing a lot of global themes, from his India basket, is not really playing India. So when I look at our India portfolio, I mean, I have an option. I can play these themes too, as well as buy some of these stocks directly, which are a play on similar theme, for example, US healthcare and so on. So we remain underweight in India, basically with exposure again in healthcare, in some of the larger companies and so on. But I think it's much easier to identify what will do badly rather than what will do well. And my plan is try to avoid as much as companies which will do badly going forward. And they are pretty much the leveraged businesses or companies dependent on governments in any way, government-owned enterprises, because the government needs money, they will sell these companies and so on. So as long as we can avoid these kind of gruesome kind of businesses, I think the portfolio should take care of itself.
Great. Now, let's talk a little bit more positively about India. We've had enough negativity. One of the things that has been surprising is the amount of money that has come in the form of FDI. I mean, we've had some tremendous deal making, which was shown by Reliance. Even the other financials which have come in, they have been able to raise a very, very large amount of equity in a very short period of time. So that does indicate there are some strengths that foreign investors are seeing. And is it, from a portfolio perspective, is it better to own those companies which have been able to raise capital in this environment?
Maybe I'll in some sense, the two sectors are, Reliance and the private banks who've been able to raise money. And we know that, private banks historically have been, in some sense, gatekeepers, right? So they've been able to raise money at 4 or 5 times book value and lend money to Indian SMEs or consumers at, 13, 14, 15%. And, that's what has kept the valuations going. So maybe, and we know that they have a secular competitive advantage given the weak competition. But in this environment, I mean, the question to ask is, how much risks are they ready to take? What is the true quality of their loan book, and so on. And again, the jury is still out. So in my view is that they will be trading bets, but again, it's very difficult to call as of now, in my opinion.
Okay, and from this trade war that we are seeing in China and US, you expect India to benefit in some ways? Any manufacturing moving to India in the longer term, or India becomes a more strategic ally for US? Is that going to be long-term bullish for Indian market?
I think there will be small wins. Unfortunately, there's a saying that I guess applies to all emerging markets, that a crisis is a terrible thing to waste, right? In terms of making structural changes. I think what we've seen from the government is some nice moves, but unfortunately, I've not seen in this crisis a structural change in land, labor, and other things which could really, really catapult India to be the biggest winner. So I think the biggest winners of this China trade war will continue to be countries like Vietnam and others in Southeast Asia, and maybe even Mexico, and maybe even sourcing in the US. India will be a beneficiary from its small base, but it won't be the big winner that it could be if we had seen some more structural, bold actions.
Okay. But if you were to think about what is it that the government can actually do, what would be the top 2 or 3 recommendations from your point of view that you would like to see RBI and the government sort of going ahead with? What could they do to help the economy?
I've already said my piece, but I will say again that I think we need a bankruptcy process which can quickly restructure these loans. And I think it's very good. As you said earlier, they're raising money. The banks are raising money because they realize, the private sector banks are raising money because they realize that they will need to have the balance sheet to be able to write off the loans that will need to be written off. But having a system whereby the economy can come back quickly as you go through this restructuring, the businesses, restructure loans, having a process for that is very important in these times. And I think, the old games of land and labor, fixing some of the lacunae there, although, I think the states have done a little bit, but I don't think, to me, it's more, I think the reason that Indian businesses are unwilling to invest in India is because they don't have confidence about, the policy framework, the economic outlook, whatever. We have to figure out what is it to get business confidence. And part of it, I think, is fixing the whole NBFC mess. The whole financial system is broken in terms of as a source of liquidity. And so I think more reform or more support to the financial system, taking some bold steps there. And land labor, are old bugaboos.
Karthik, anything on your wish list on what we should expect to see?
Yeah, so there's a severe excess capacity in practically every industry in the country. So the difference between a 2-year recovery and a 5-6 year recovery is going to be how quickly and effectively the government intervenes in many key sectors. It could be infrastructure, it could be manufacturing reforms to get this stuff going. It could be investing in certain key sectors. That's something which the government needs to do and do very, very fast. Otherwise, we will see a situation where we're looking at a 2-year recovery could easily become a 5-year recovery. So the government intervention now is very, very important.
Right.
It's needed much more than ever before.
And are you seeing, and you do talk to a lot of people in the government ministries, Karthik, are you seeing any activity on that front? Do you expect something to happen? Or is it just a wish list?
What we are finding is every district has these small EPC players who make 20, 30, 40 crores revenue. They lay the local roads, local water pipelines. And we are talking to a lot of them on our road trips. And we find that everybody has stopped work. Stopped work not because labor is not available. They're not stopped work because there is a lockdown going on. They have primarily stopped work because they don't have the confidence that the government will pay them. So the 2007-8, the crisis and the long infrastructure crisis in India has meant that small contractors are running very scared of the government. They know that COVID has stretched state governments. So they know the state governments are not going to be allocating money to pay these projects. So practically work on the infra side across small town India is dead. Any work which gets done is a personal assurance from the collector calling up the guy and saying that I will make this payment, you please come and do this work. Otherwise, people are just walking away from government contracts.
Yeah. I think in India, what we are also seeing is actually a de-stimulus, forget a stimulus, right? Because if you look at government payables, what I understand is about 4 or 5% of GDP. So on one hand, governments has announced a fiscal stimulus of 2 or 3% of GDP. So net is actually a de-stimulus. So my recommendation is if the governments actually just pay all the outstanding, it will be a much bigger boost to economy than anything else. Because that will actually set up a virtuous circle. And I mean, in some sense, that's what the entrepreneurs need. I mean, India, if you see, is among the few economies in the world where nominal GDP is growing at maybe 5-6% or maybe less, and a BBB or even a AAA rated borrower cannot get money for less than 1.5 times nominal GDP. It's unheard of. I mean, there is no country in the world where interest rates are 2 or 3 times nominal GDP. So So my recommendation is, just to pay people back.
Yeah, I mean, that's true. But if that were to happen, one would presumably think that the old economy stock, the infrastructure stocks, and those ones will be the one which will actually do better going forward, because I mean the valuations have been trashed for those stocks quite massively. If government does do some kind of stimulus for infrastructure.
So discretionary spending is practically dead, Prashant. So, and private sector capex is not going to come back for many, many years. So the only way you can stimulate anything in the economy is government making those hard investments, hard calls, as Amit says, pay back the money, put the money, bring in more money into building out the roads, building out the structural reforms. So it's quite a challenge if you look at it that way.
Okay. I think we've discussed a little bit on the sectors. Arvind, you made it very clear. Your portfolio is mostly outside facing, so to say, IT, pharma, and all. Any view on financials there? What is the generic view on because financials is a big part of the index. So should people be investing in financials, or if yes, then which ones?
Just the top 3 or 4 private sector banks. Why would you? And again, NBFCs have a liquidity problem. They have not fixed. The public sector banks are going to be required to do all kinds of national service during and after COVID. So it leaves a very few handful of banks that will both gain market share and come out of this with having managed their risks well. And I think the deposit side of the franchise has become very shaky again, except for the top 3 or 4 private sector banks with the experience with a couple of banks and financial institutions in the last 1 year. The deposit franchise for some of the smaller banks has also come under attack. So I just think that looking for value in smaller banks which specialize in self-employed or small businesses, it's too early to be dipping toe into that, in our opinion. So I think the financial sector, which was, it is the biggest part of the market, and which was a generic overweight till the NBFC crisis, has been for us a significant underweight before and an even bigger underweight after COVID.
Amit, I'm guessing if you're bearish on markets, Indian market, then you would be same position on financials.
I think it's not an easy answer because the way they have also underperformed. So if you look at globally, right, financials, whether it's in US or Europe or India, have been the worst performing asset class. And that's a lot to do with, everybody getting super excited about work from home and NASDAQ basically. So, so if, for example, if a lot of market participants feel that NASDAQ is in a bubble or NASDAQ doesn't really do well, then it's quite possible that financials will actually come back. And yesterday's price action was quite interesting, right? When NASDAQ's down like about 2-3% and financials were actually up. So, so one has to keep that context in mind, looking at valuation of other sectors to make even a call on financials. I mean, the good part is some of the Indian private banks have faced crisis before. I mean, they've faced a crisis like demonetizations and have survived. They've been able to raise capital and so on. And you got a really weak competition on the other side. So, so there are definitely positives on that, but I don't think so it's an easy answer as of now.
Karthik, if I got it right, I believe you don't have any financial in your portfolio, right? You're totally underweight on that for the same reason.
Yes, we are very underweight. You could see liquidity coming into second-tier companies and banks if this global liquidity rush into emerging markets continue. But on a fundamental basis, we find it very, very difficult to invest in NBFCs and smaller banks. And this is part of the overall theme I was talking about earlier, which is in every sector you are finding 3, 4, 5 companies taking away a substantial part of the market. So, and banks, I think this is playing out very rapidly. The top 4 or 5 banks are incrementally accounting for most of the loans as well as most of the liabilities. So, and those guys and those stocks could have their own NPL issues as well as valuation issues. But if you go into the next level, guys, the question we keep asking is, can these guys get to a 12% ROE? And it looks very, very challenging if you leave the top 4 or 5 guys out of the picture.
All right, I'm just trying to see some of the questions which the audience has been sending. One is about this high valuation issue for India, that all the good quality stocks remain very highly valued. Even IT and pharma is getting into that territory now. So do you continue to hold on to your highly valued stock because the trend is in the favor, or is it time to start doing some switching? Arvind, I think mostly directed at you.
Okay, well, so far we have not yet done switching, although we did take some profits proportion on one of our stocks, which still is going up. But I think that, at the end of the day, we try to get growth at a reasonable price. So yes, there will be time to take profits here in the near future if we see but the liquidity is continuing. And one of the challenges for us is if we sell our winners, which are looking a little expensive, where do we put money? Because I'm not a believer that, I know that, both Amit and Karthik talked about the fact that what the government should do, but there's a difference between what the government should do and what it's likely to do. If the choice is between spending on infrastructure and giving money to voters, it is clear where the money is going to go, right? So there's a limited amount they can do in infrastructure and other things. So yes, we are looking to take profits, and I guess we're getting close to pulling the trigger on some of our positions, which have moved a lot. But our big challenge is redeploying that capital into areas that we find attractive. And I think financials is probably one of the areas where, again, other than that gold loan company, we're very underweight. And that's one of the areas where one of the top 3 or 4 private sector banks would be interesting to us because of the same reasons that Amit mentioned. So I think that there is some potential to move into sectors like that versus some of the pharma or other winners which have moved a lot. I don't think the IT has moved as much as pharma. I think pharma is where, with the IT, there's a lot of companies that are still available, not, I wouldn't say cheap, but bit of a turnaround or undervalued stories. There are a few available, and I think the secular growth could be surprisingly good. But in pharma, things are getting a little crazy.
And given the generic, mostly bearish view on the Indian equities, Amit, question for you. Do you think Indian investors will do well to diversify their equity holdings into more international and global stocks?
Absolutely. And that's what I've been telling my friends and family over the past few years. I think Indian investors are exceedingly not diversified. I mean, most of their wealth is in a single country where, policy missteps have been quite terrible over the past few years, resulting in significantly weaker growth. Markets have done badly. Real interest rates are pretty much close to negative. So I think it's extremely prudent for Indian investors to diversify globally, invest in alternative assets, find investment themes that are as much uncorrelated to Indian equity markets, and be broadly diversified.
And Arvind, question for you. Now that, it's a momentum-driven market, we know that the fundamentals are a little bit challenged. Do you think investors should also diversify it into more absolute return strategies, like the hedge fund kind of strategy that you run with long short?
Well, right now we've been running, and we run globally long short. India, we have a long only strategy, but I'm actively thinking of doing long short in India, because I think with the valuations getting where they are, there are, like Karthik mentioned, I think there are some really juicy shorts that are going to emerge here in the near future. Because again, like Karthik and Amit, my views on the Indian economy and economic recovery is that it's not going to be V-shaped, and I think some of the valuations are going to get to levels where I think long short makes a lot of sense. And I think one of the things that we worry about is also the currency risk. So there are going to be winners from a weaker currency, and there are going to be, again, the outward facing, and there are going to be losers, those that rely on foreign sourcing. So there could be many themes that could be played through a long short individual stock picking, obviously, and some themes. But I think yes, that makes sense given the market has run up as much as it has.
Okay, so people want quick thoughts on different sectors. I think that we will keep it as the last bit of our this thing. Anybody can take these. Any thoughts on public sector undertaking as investment? They're very cheap, high dividend yield. Is it something people should look at in the portfolio?
I do think dividend yield stocks will make a strong comeback. This is because we are looking at a world without much growth. India definitely doesn't look like we're going to have a lot of growth in frontline companies. So I think companies with zero debt, it's very important to distinguish public sector companies with debt and without debt. So companies with zero debt who are very cheap, and there are a lot of them with dividend yields close to 10%, some cases more than 10%. I think in a low interest economy with very little growth, I think dividend yield will come back very strongly. There's not just public sector companies, but across India, I think dividend yield is a very, very good place to hide.
Any particular names that you have in mind? I think some investors would like to know here on the forum. Anything that you can publicly talk about?
Yeah, I think there are a lot of PSUs. For example, there's a hydel power company with zero debt called SJVN. There's Coal India. There is many companies. Just to name a few, these are companies with 10% plus dividend yield, and the long term doesn't look bad. They could have 4-5% growth, and very, very safe companies.
Okay, the other question on chemicals and contract manufacturing sector. I guess similar fundamentals as to pharma. Is that something that can also be considered for investment? Anybody can take that.
We don't have an investment right now in the chemicals space. We have a little bit in contract manufacturing, more pharma related, but I think that that's one area that we are very interested in. But the valuations have gotten a little ahead of themselves in the chemicals space. But it is a beneficiary in some ways of the China, moving away from China theme. But again, valuations are always a challenge in some of these sectors like that, which have become very popular.
The other question, like we follow commodities side very closely at Alpha, and we are seeing that the crop has been quite good in India. In general, so far COVID has not impacted the rural sector as badly. Do you think that will qualify as a good sector to look for investment for the portfolio? Agri related?
Related, yes, but the rural theme is probably overstated. What we are finding is probably 30% of rural income is agriculture. So to that extent, there is a dependence on urban and other parts of the country, urban economy to flow through into the rural areas.
All right. I think we have kind of run out of the time. So there are some questions still coming up. Maybe I'll just take one, which is I guess of a lot of interest to investors, is on the dollar rupee rate. Any views on that? I mean, rupee has been surprisingly strong in my view, given historical crisis have always depreciated rupee in a meaningful way, which is not happening now, maybe because oil price is low and domestic demand is very low. But in general, what is the outlook for rupee versus the US dollar?
I've already said I'm nervous. Medium
Okay.
term, when the liquidity goes out, not in the short term.
Amit, same views?
No, I think it depends upon how the US dollar behaves. Right? I mean, what we saw last month was the US dollar depreciating about 7 to 8%, and all emerging market currencies actually held up well. In fact, but within the emerging markets pack, actually, Indian currency is actually not done well. I mean, if you look at, for example, Taiwan dollar or Korean won, they've actually done reasonably well compared to India. So, but again, in the end, it all boils down to the growth of economy. Is India effective in controlling the COVID situation? Because it's quite possible the world suddenly just focuses on India. Just like the world was focusing on Italy, and did panic about Europe in some sense. So one could panic about India, and then it impacts the currency and so on. So it's not an easy answer. But I agree with Arvind. I mean, over a longer term, if fundamentals don't improve, if growth doesn't improve in India, then currency will weaken.
All right, I think that's it. I know questions are still coming in, but we are running out of time. We had said 1 hour for this thing. So I want to thank everybody on this panel. I think the sense that I got, and it's probably true for everybody, that generally you have to be cautious about equity market. The economy looks, poised for a tougher time going ahead. And right now you can play momentum, but you have to be very selective. You have to keep your portfolio position very selectively. Maybe diversify internationally, diversify into other strategies which are more absolute return strategies. And that is the way to sort of defend and protect your wealth in this current environment. Thank you very much, Arvind. Thank you very much, Amit. Thank you very much, Karthik. It has been a great session. I hope everybody enjoyed it. And we will see you for our next session in 2 weeks' time. Thank you very much.
Thank you.
Have a lovely day.
Thank you.
Thank you, Prashant.